here is the world as I see it today. The issues on the left are positives. The issues on the right are negatives. I think if you asked any of us in this room which would be the longer list, the positives or the negatives, I don't think it would be much of a reach to say that the negatives usually are longer, but at this point in time might be a lot longer than the positives. Maybe it would be difficult to even come up with 3 or 4 more positives on the left side of the page. That being said, let's pay most attention to the middle, because this is going to drive equity markets, risk appetite. All these issues, I think, come down to 3 things. I'm trying to, like I said, offer perspective. Trade and tariffs, huge issues. The trade and tariff war has the potential all by itself to drive us to global recession. Trade and tariffs act as taxes, right? They act as supply chain tax. They act as a consumer tax. Here comes holiday season. We'll have to see these tariffs, right? There are meetings taking place between Chinese and U.S. officials coming up next week. But then tariffs are set to go into effect or be raised mid-October, others in mid-December. So they are coming. And even yesterday, there was also talk of trade and tariffs on European goods. So understand that Donald Trump, ever since he was a child, going back decades, has talked about trade wars and use of tariffs in his policies. So we're going to have to monitor this going forward. Understand that markets do not like trade and tariffs. They like free and fair trade. And I also don't think that markets are pricing in. They're watching the trade and tariffs issues play out. And I don't think the good or bad is priced in. I think the market really doesn't know how it will end at this juncture. My own personal belief is that we are in this for a while. There will not be any magical document signed which will take away the trade and the tariff war. And I also believe, regardless of who is elected president in 2020, that trade and tariffs are going away anytime soon. I think Trump has opened Pandora's box. China joined the WTO in 2001 and sort of has been cheating ever since. And eventually, and now the world has sort of said, that's enough. And so I think this will be an issue, a variable which will drive market returns going forward for quarters and years to come. Fed policy, easy money, low interest rates, all these things are very important to all of our worlds, and also how capital is deployed in risk assets or not. So the Fed not only sets rates, but I think also sets appetite. The Fed pivoted last year to a neutral stance after markets had fallen nearly 20% in the US. We troughed on Christmas Eve. The Fed has now gone all the way from a tightening cycle to an easing cycle. So we'll talk about that more, but please understand that is extremely positive for risk assets, capital markets, and for your businesses. I know rates are already low, but the Fed standing there sort of as a backstop is a very good thing to have on your side, especially as things get bumpy. The main economic variable you need to pay attention to, there are many, right? They get released every day, but the main one to pay attention to is inflation. We are late in an economic cycle, and late cycles tend to be inflationary, both from a wage, right? Primarily from wage pressure. You sometimes get commodity push, but bull markets tend to end with high inflation. The Fed was only able to reduce interest rates the past couple of meetings because inflation is low. If inflation were to spike, ties the Fed's hands, the Fed can no longer ease, and we'll talk about that on the next slide. So inflation to me is the key variable. Please pay attention to it. I've learned in my 30-year career, never turn your back on that variable. It has a way of showing up sometimes when you least expect it. So that's sort of the current view of the world. Let me now sort of take a step back. I'm going to cut my head open. I'm going to let you sort of walk through it and sort of see how a strategist views the world. All right? What's important, what isn't, and also sort of answer some of the questions, again, that a strategist can bring to a group of entrepreneurs. So this was a chart that I actually created some 17 years ago. This page that you see in front of you is 17 years old. I drew this page on my desk in San Francisco, California in 2002. I didn't realize when I drew it that it would take me around the world explaining it to people. I have explained it to some 80,000 people as far away as Shanghai. So it has somehow resonated with a group to allow them to understand how the stock market and the economic cycle work together, and then also to answer questions such as, what does that mean for a small business owner or a business owner who has all their capital tied up in their own company? So let's go through it sort of one by one. I'm going to be quite quick. But this is an economic cycle at its base. A trough is at the bottom of the page. A peak is at the top of the page. The left-hand side is all the good stuff, expansion, and the right-hand side is recession or contraction, depending on severity. Notice those are the only economic markers that you really need to pay attention to. So let's look at the bottom, high unemployment. So economic troughs and stock market bottoms tend to take place when the unemployment rate is high. 10% was the unemployment rate in 2009 and in 2010. We then improved 9.9, 9.8, 9.7. Today we sit 3.7% unemployment in this country. Notice that going from high unemployment to low unemployment, which sits at the top of the page, stock markets, of course, go up in that time horizon. So think about it. I drew this 17 years ago. We've gone from high unemployment to low unemployment. The market's up 400%. And it's paying, really, if you just paid attention to that one variable, you would have been in the market early and you'd still be in the market today, because the unemployment rate has not gone up at all during this whole bull market run. Commodity prices rise as the global economy catches gear. Declining inventories, profits accelerate mid-cycle. That's important for business owners. Capital expenditures go up around mid-cycle bull runs or mid-cycle economic move. Notice how long we wait in order to deploy capital for long-term needs. We tend to wait for the recovery to almost be half over before we have sort of the confidence to deploy capital. From stage left, enter bull market killers, rising inflation, and then the Fed must raise interest rates in order to combat rising inflation. So that's what we were talking about. That's how bull markets and economic cycles end. The Fed tends to murder them on purpose with a candlestick in the billiard room is how I go on to answer that question, okay? They murder them on purpose. Because inflation is high, or the threat of inflation is high, the Fed must step in to bring us to soft recession. 7 then becomes 1, 8 becomes 2, 9 becomes 3, 10 becomes 4. There's symmetry, of course, in an economic cycle. There's Economics 101 in about 2 minutes. Okay, but that's how cycles work. If you don't see it on this page, it's not that important economically. The price of oil is a variable that's important that is not included. But other than that, man, I'm telling you, there's a lot of news on TV that doesn't have much impact on markets overall, that isn't dominated by what you see behind me. I talk about the human being and our emotional states as we go around an economic cycle. I'm not going to spend much time on that here. Suffice to say, we are lousy investors by makeup. We are wired to sell low and buy high. It's what we do without effort. It helps us survive in the woods. These are good traits to have as a species, but man, they make us terrible investors. We are upside down most of the time. What your gut is telling you to do in your investment portfolio is usually wrong. It's not half wrong. When you think you should be selling, you actually should be buying. So it's not that you shouldn't sell, it's that you should actually do the opposite of what your gut is telling you to do. Very interesting. We're fearful at bottoms. We're disgusted with ourselves that we sell at the bottom, but we doubt that the rally is real. A wall of worry, all bull markets climb these things. So you can see it takes about 5 hours. Fear to greed. Markets go up about 100 and 150% before we're even re-engaged in them emotionally. We're wired to, of course, buy high. We're euphoric. We love high prices. We think there's something going on, or everyone's making money except me, so I got to get in. So again, we're wired to buy high. We buy high. We wish and hope that the stock would go back up to our costs, because then we'd sell it, but it doesn't. We self-loathe as it falls farther. So we're wired not only to buy high, but then to hang on to the thing all the way down until the trough. So please understand, again, I wanted to teach investors about all the mistakes that we make kind of without effort. The proper mindset is on the innermost circle. So contrarianism is necessary at 6 o'clock, right? You have to do the opposite of what every bone in your body is telling you to do, which is run and hide. You have to do the opposite of what everyone else is doing. Of course, this is easy. Be a contrarian and buy what everyone else is selling. As a strategist, that's my job, right? I'm trying to find those times to help our clients navigate economic cycles. So my job is to buy from fearful sellers if I can. Positive bias as you climb a wall of worry. That's what bull markets do as they enter mid-stage. Aggression can be played late cycle. This is very important for business owners. The markets reward growth companies in their late cycle. Growth becomes scarce economically, so any asset that becomes scarce, what happens to its price? It goes up. If you're a company growing in a world without growth, please understand what will happen to your individual multiple, right? It will go up substantially. So growth stocks tend to have incredible beauty as defined by the market in late cycle. When you get to 12 o'clock, everything changes. The market changes how it defines beauty. It likes value, it likes safety, it likes quality. So it changes its whole view of what's important. And finally, 3 o'clocks, that is the worst time on this wheel. Bear markets don't start brutally at 12, but they can end brutally at 3. 3 o'clocks, you'll notice the words in the Innermost Circle are capital preservation. Bear markets end brutally. The baby gets thrown out with the bathwater, allowing the contrarian to separate baby from bathwater and make all the money eventually. The good news here is that the only part on this wheel which is typically skipped historically is 3 to 6s. They tend to only happen once in a generation. Most bear markets are only, they're soft. They last 12 to 18 months. Stock market goes down between 10 and 20%, and you come back and you reset to 7, and a new bull market begins. So that's what I drew on my desk. 90 minutes it took me to draw this, but it took me 25 years to sort of figure out sort of what does this actually mean. So what I've done over the 25 years, I drew this in 2002, as I mentioned. It was half art and half science. And what I did was I took the next 6 years, 2002 through 2008, and I removed all art from the page. I removed all art. So I can now tell you what time it is based upon historical perspective going back to 1969, using only data. And because I've removed all art, I've also removed that emotional ring is completely gone. So now let's sort of go through. And I'm asked because of that, well, I can run any data through this map. And one of them is, well, how does it help a business owner? So the question most business owners face is, well, I want to sell my business. What time should it be in the capital markets and the public markets that I should sell my business? So I went back. You guys can look at the data too. It's all in the public domain. And it looks like an EKG. Multiples paid for businesses from 30,000 feet looks like an EKG, and it has spikes in it. And if you're a business owner, man, you'd like to sell when the multiples paid are the highest, of course. And this helps answer that question. I've mapped every 6 going back to 1969. I then mapped every 12. So I mapped tops and bottoms. I then mapped every 7, every 9, and every 10. And I came over here and I also mapped every 3 going back to 1969. When I looked at that EKG of multiples paid for businesses, every spike is when the capital markets were at 10. When the public markets, when this arrow was at 10 o'clock. Therefore, if you're a business owner and you're in a late cycle bull market, growth is outperforming value, all those things are going on, you should be looking to sell your business. That is when multiple offers come to companies, right? That is when you get in bidding wars. That is when people will pay you a multiple that you deem appropriate. I do not know any business owner who undervalues their own business. I have yet to find one. So 10 o'clock, you may get a buyer that comes in and pay you a multiple that you think is worth it. At 12 o'clock, the business owner must protect their business. Don't expand, don't take on debt, right? Don't enter into long-term contracts. Let your competitors do that. You know it's 12 o'clock. You know a recession, soft recession, whatever the case may be, is coming. 6 o'clock, 7 o'clock, cheaper capital, borrow and build. Go after your competition, take them out, merge with them, whatever it takes, borrow money, cheap money. We normally don't do that till 9:30. Like I said, capital expenditures don't typically increase but until 9:30. You'll pay higher interest rates and higher asset prices for anything you're doing at 9:30 that you could have done at 6 or 7. So that is sort of how it pertains to the business owners in this room. Where are we today is the question, of course. We sit here today, purely quantitatively. Believe it or not, this stock market is continues to act like it is in a mid-cycle. But the economy, please take a look at the economic arrow. That is art. So I wanted to put another arrow in there while the stock market's behaving this way. Positive bias, we sit near all-time highs in the stock market today. And yet we're fretting. That's what we're doing without effort. The economy, however, is probably in the 8th or 9th inning. We continue to believe that while no recession comes in 2020, recession is probably, the probability of recession in 2021 remains quite high. So that your ability, the window open, if you are thinking of selling your business, my words for you would be simple. Don't dawdle. We are in a window which opens, and I can tell you how 9 o'clocks and 10 o'clocks, how often they happen. 10 o'clocks tend to happen once in a decade, and they last 25 months on average. Once in a decade, and they last 25 months on average. That is the data. So when the window closes at 12, it's 6, 7, 8 years possibly to get back to another open window where multiples will be paid for you that would be appropriate. So again, I'll be around for break. I'll be around for questions as the day sort of roars on, but I wanted to set that framework for you to sort of tell you from a macro perspective where we are. It's purely quantitative, no sort of view or vision. So let me turn it over to Chris. He can do a little bit deeper dive. We did pre-meet just for a few minutes, so I hope he dovetails with this work. Anyway, I'll turn it to him, and again, I'll be around for questions during breaks and everything else. Chris, I'll turn it to you. Thank you guys very much.